we believe that the price will be tenfold of where it is today. So instead of 45,000, over 500,000. In terms of our investment time horizon, 5 years. So we have to believe that one of the technologies, the 14 technologies around which we have based all of our research, is going to inflect within 5 years, or at least be discounted in the start to be discounted in the market as though it is about to inflect. So 5-year investment time horizon, our minimum hurdle rate of return is 15% at a compound annual rate over 5 years. And so I think that that combination of 5 years plus exponential growth trajectories is what is finally starting to get into the market. I've been waiting for years. I believe we are seeing, it's going to be incredibly confusing, I think, to people. Just look at what's happened to the bond market this year. You know, against all expectations, yields have dropped from, I think it was 1.75 at the peak in March down to 1.3 as inflation expectations are exploding, right? We believe the reason for that is that we're probably, when all is said and done and the dust clears from the supply chain problems and everything, we're probably in a highly deflationary world. And we see 3 sources of deflation. One is very good. It's called technologically enabled innovation. Artificial intelligence training costs are dropping 68% per year.
Right.
When a cost drops that much, the demand for it picks up. And artificial intelligence is probably the biggest reason we're seeing the convergences between and among technologies. So we've got one S-curve feeding another, explosive energy, incredible deflation. That's the first deflation.
While the rest of the world thinks, I mean, if you were here for part of the day, everybody's talking about inflation.
Oh, and that's what I love. You know, if the whole world thinks that's going to happen, and a portfolio manager and analyst team thinks that's going to happen, well, if we're wrong, it's not going to matter that much, right? Because nobody's expecting it. It's not in the market. But if we're right, the returns are enormous. And I think that's what's going on with the technologically enabled innovation that we see, especially in healthcare, by the way. But there are 2 other sources of deflation. Disruptive innovation, there's another side to it. It's called creative destruction. And I think we're going to see more creative destruction than we have in all history during the next 5 to 10 years. Now, you can say, oh, you're just talking your book. We have rights law teaching us about learning curves and cost declines that suggest we are going to see incredible booms out there in parts of the world, but it's going to mean tremendous destruction in others. So when I say confusing, I mean that. And then the third source of deflation, I think, will be cyclical deflation. Most people are fighting us on this one. It's hard to fight us given our research on those other 2. But this cyclical deflation, it started with lumber, $1,711 in May. Now we're at $500. Copper, $490. I think now we're at $425. Used car prices are surprisingly good, and I know we're getting pushback on this one too. They shot up 60% as everybody decided to avoid mass transit last year, right? And now we find ourselves supposedly in a chip shortage. I do believe in the chip shortage. Because
you believe there's a chip shortage.
I do believe there's a chip shortage because the world's going digital. But I believe.
But wouldn't that be inflationary?
Well, I believe chips are the new commodities. That's the point I'm making here. So chips are going to be what Dr. Copper has been in the industrial world. This is Dr. Digital, I don't know, in the form of chips. But you hear the auto industry screaming. You know, auto sales have dropped from 18.5 million units in April to 13 million. Now, these are annualized rates in August. That's more than a chips shortage. What happened last year is people bought the cars, They're in their driveways, garages, didn't want to take mass transit. And now there's a decision. What do I want to buy? A gas-powered car or an electric vehicle? Well, that's where the short supply is. And I think the excess supply is going to be in the gas-powered side. So this is a really important test case of why I formed the firm when we did. I think the disruption is happening to the auto industry now. I think regulators, our working assumption from the beginning was that, and this was based on meeting with them, meeting regulators, both state and local and federal, was that no regulator wanted to be blamed from preventing the next big technology breakthrough to happen in the US. And that has proven true. Now we've got Chairman Gary Gensler. I'm really happy he understands crypto and understands the merits of Bitcoin in particular. He is a regulator, though, and he's a hardcore regulator. What Coinbase did, I mean, I was shocked when I saw Wells notice. Are you kidding? They haven't even released the product. Like, what is this? And I think what that Wells notice is doing, it's a call out by regulators saying, we got to discuss this stuff because this is happening very quickly. And I think we are going to bring courts into the system. This happened in Canada. A company called 3iQ sued the regulator there and won in court. So they were able to issue Bitcoin ETFs and closed-end funds and Ether as well. So I am beginning to think that Coinbase doesn't mind this at all. And if you saw the stock reaction, it hardly budged. Right. If we're right and companies continue to diversify their cash into something like Bitcoin, and institutional investors start allocating 5% of their funds towards, I'll just say Bitcoin for right now, because we did that, we framed it for Bitcoin, could be for other cryptos as well. We believe that the price will be tenfold of where it is today. So instead of 45,000, over 500,000. That is becoming a harder and harder question to answer. I think I'd default still to Bitcoin because countries are now deeming it legal tender, and we haven't even put that into our thinking. Ether, however, is seeing an explosion in developer activity thanks to NFTs and DeFi. I'm fascinated with what's going on in DeFi, which is collapsing the cost of the infrastructure for financial services in a way that I know that the traditional financial industry does not appreciate right now. So it does have to move from proof of work to proof of stake. That transition is underway and seems to be taking hold. So here's how I'll answer that question. Our confidence in Ether has gone up dramatically as we've seen the beginning of this transition from proof of work to proof of stake. We'd still probably do 60% Bitcoin, 40% Ether.